things about myself through the presentation. I hope that's okay with everybody. It is personal, but I also want to empower you and give you some rules of money that everybody must master. And we don't always know these rules. But I want to first start by applauding all of you who are here. We had another presentation in Spanish earlier with about 15 people. And I want to say that the fact that you're here already says that you are willing to get ahead. But the only way we can get ahead is to get started. It's not enough to make a list of things I want to improve in my life and then put that list away in a shelf, right? Or on a drawer or whatever. I have to get started. So getting ahead means getting started. You're going to see that women are ahead of the game when it comes to many, many things. It's a wonderful thing, and we should be celebrating this. And when it comes to education and business, we are definitely in the lead. Here's some things that you'll see. You'll see that, and these are statistics that are taken, you can look online, but when we talk about college degrees, 57.5% of bachelor's degrees come from women, 61% of master's degrees, and 52.7% of doctoral degrees. That's huge, right? And at a time, I mean, I would say like maybe 50 years ago, the numbers were not here. So we're definitely breaking records in education. When it comes to working, we also know that 46.8% of the workforce are made up of women, and 52% of professional and managerial occupations are made up by women, right? So whatever kind of a job you have and whatever jobs are out there, more than half of the roles in leadership are taken by women. I wish we could add one more line, and the next line would be that close to 100% of entrepreneurs and women who are taking care of business at home, right? Because most of us are doing both outside jobs and inside jobs. We're doing the jobs in the house as well. And that's a lot of managing as well. So the managerial jobs in the house are mostly taken by women. We also know that about 9.9 million businesses are owned by women, and that has to do with the technical and the Silicon Valley type, but it also has to do with daycares and any kind of a position or any kind of a business that you can think of. 9.9 million in the US are owned by women. That's a big number. That's something to celebrate. Let's take a look at some other facts. Okay, we know that as women we tend to make less money. We also experience more interruptions and reductions. When do those happen? Well, let's think about when you have a baby, right? We stay home with the baby. Generally, it's us. In some cases, the husband has also stayed home. But in most cases, the woman takes that break. If we have to take care of elderly parents or elderly relatives, traditionally, generally, it's done also by women. So that means that we're working less amount of years. When we're investing more conservatively, and that's not a bad thing, but it also means that sometimes, we're making less risks, and therefore we have less for the future. We save less for retirement, and this was a shock to me. I assume that everybody who is working is saving for retirement. That's not the case. And I assume that even those women who are not working outside of the house were saving for retirement, and that's not the case either. So most of the retirement accounts are owned by men, and we have to change that. We also rely more on Social Security and other departments and programs by the federal and the state departments, and we put too much faith in our 401k. Our 401k is one of the examples of retirement plans through work. But in general, we put a lot of faith. We trust those. We also live longer, and we know that, right? We all live a much longer life. And again, it's something to be thinking about, because with living longer also comes more responsibilities. So let's take a look at a few more facts. 80% of women don't know, I would say much, anything maybe a little harsh, but 80% of women don't know enough about their financial status, right? Even those women who are taking care of the shopping and the groceries and paying the bills, that's part of the financial status. The larger financial status is also, how well is my family protected? Do we have something set up for the future? Am I saving for my kids' college? Do I have, my assets managed well so that, I have an inheritance, a will, and a living trust in place? All of those things are part of the financial status that we need to be aware of. So just to sum it up, compared to men, women typically earn less money, spend fewer years in the workplace, and we live longer. So that when it comes down to it, nearly 90% of women will end up managing their finances alone. And that is a number of different things. That could be women who are single, right? Women who are single moms, women who are married but have a divorce or are separated or we become a widow. So 90% of women will end up at some point of their life managing their finances alone. We also know that 46% of Americans, and now we're going to go from women to the larger picture, thinking about everyone, right? Thinking about men and women. We know that 46% of Americans don't know how much they have saved for retirement. That's very alarming. Doesn't mean they don't have a retirement plan, but they just don't know how much they have saved or how their retirement plan works. This is what we do know. When we look at the statistics, this is the reality, right? 1 in 3 Americans has zero saved for retirement. 1 in 3. That's huge. And that's what you see right here. So 33% don't have anything saved for retirement. Out of the other 2/3, this is what we know. 23% of people have less than $10,000 saved for retirement. 10% has between $10,000 to $49,000 saved for retirement. 8% has from $50,000 to $99,000 saved for retirement. Another 8% has between $100,000 to $199,000 saved for retirement. 5% has between $200,000 and $299,000 saved for retirement, and the last 13% has more than $300,000. Now that sounds like a pretty good number, but let's do a little bit of math. So take the amount of money on a monthly basis that you think you need to live comfortably. Okay, let's say that you need $7,000 to live comfortably today. That times 12 would be what you need on a yearly basis. And then I want you to use that number and times it by the amount of years that you expect to live beyond retirement. I'm hoping that we all live at least 25, 30 years, depending on when we retire, right? So if you do the math, we all need at least $1 million. I would say closer to $2 million by retirement so that we can live comfortably, because that is the money that will give us the quality of life. And so when you look at these numbers, it really means that there's a possibility that a third, 13%, actually it's less than a third, 13% of Americans right now have possibly enough for retirement. And this is what we see when we talk to families as well. Let's go back to women. Okay, we were looking at everyone, back to women. This was also very alarming. This is, you can look online, you can do your own research. I did. Nearly 1 in 5 working women have nothing saved for retirement. That's $0 saved for retirement. And we're talking about working women. I sit down with couples all the time, and the husband will have a retirement plan and the woman doesn't. Even if she's working outside, the money from their 401k was pulled for an emergency. They were, trying to be conservative and wanted to save more on his retirement plan and not hers. For different reasons, women are not saving enough for retirement. Couple of other reasons why. Women earn less than men do. We earn about 81% on average to $1, right? For that men earn. And we also know that we live beyond 85 years old. There's 2 women for every 1 man who is 85 years old and older. That's a very big contrast, right? So we make less money and we have to save more from less, and we also live longer years. So those are things that we need to be aware of. Often I meet with families and with individuals who say, I just don't know how I'm going to save. It's really hard to save money. You're going to see today that there's a few different things that we're doing wrong. But to illustrate to you how easily we could be saving, let's think of a number like $10,000 a year. If you do the math and you divide that by the amount of days that we have in the year, that comes out to $27.40 a day. So let's assume that, that you want to put that money away. What would you do? Well, you would cut down on maybe going to Starbucks or Pete's or, the things that you're doing on a daily basis that could be pulling away some money that doesn't seem like much, but it adds up. With only $27 a day, you could actually be saving about $10,000 a year. Now we're going to look at a few situations that happen to a lot of families, and these situations are very serious, and I want us to be very respectful because we all know families who have gone through things like this. 4 in 10 adults, if faced with an unexpected expense of $400, an emergency, and they need $400, won't have enough money to cover it. And they'll have to either sell something or borrow money. That happens all around it, and we see it. Let's look at another situation. And this one, unfortunately, is also very common. When we have a household with adults, let's say we have 2 adults, traditional family of the mom and the dad, right? It could be just a one single parent family, it doesn't matter, but we have 2 adults, and those adults are taking care of all the responsibilities for the family. It feels like that. It feels like you're carrying it in your shoulders, right? And we're talking about food and car payments and the rents or the mortgage, all of the expenses, 2 adults providing for the home. Now, what happens if one of the adults cannot do that? Obviously, we know that that could be because of somebody passing, but it could also be out of a critical, chronic, or terminal illness, and the person is alive but can't go to work. So what happens then? The balance is off. A lot of those responsibilities will fall off, and sometimes very serious decisions have to be made. I've met families who have had something like this happen. They had to leave their home and go to a new place. The kids had to change districts and go to a new school. So it can be very, very extreme in some cases, and it can even be worse. But we have a few things that can help with that. And the reason I bring this up with life insurance is that traditionally we have thought of life insurance as something that becomes active when someone dies, right? It's a death benefit. The reality is that life insurances these days come with living benefits, and they also come with things like long-term care. What does that mean? That means that if in your life an adult who is insured either has a critical, chronic, or terminal illness, as I mentioned earlier, or of course if they pass, the life insurance policy actually will create income for the family so that they can maintain the lifestyle that they need to maintain. We know that there's emotional loss anytime somebody gets ill or if somebody passes, but we don't want to also add that financial stress to the family. So this is one of the ways that we know that we can help support families. Now we're going to switch a little bit, and we're going to probably look at my favorite slide. And this slide is going to describe how, one of the things that I think, let me go back. One of the things that this slide raises awareness around is the fact that the main role a woman plays is not often recognized. I grew up with a mother who is now a doctor, but growing up, she was a stay-at-home mom. She was a homekeeper. She was a groaner, or whatever you want to call it, right? She stayed home. She took care of the family. So did my grandmother. So did my aunts. And so do a lot of women that I know here as well, right? And all of the women that stay home have a sense of, well, I don't make any money. If anything happens to me, everything's okay, because my husband is the one who has to get protection because he has an income, right? So what we see often is that we don't recognize in each other, and society doesn't recognize all of the roles we do. So take a look at this number. Forbes magazine, which is one of the top financial magazines in the country and in the world, did a study a few years ago and made a list of all the roles that a stay-at-home mom, a homemaker, does, all the responsibilities, and then determine the value, the monetary, the dollar amount value of each of those roles, and put it all together to determine what a salary should be for a stay-at-home mom. You won't be surprised, or maybe you will. I always talk about this, but women who stay at home should be receiving a salary of about $178,000 a year. So this is something that you can definitely take a screenshot. You can research this article. It exists. I've shared with a few friends already. I put it on my Facebook once in a while because I feel like let's stop thinking less of women who stay home. Okay, everything they do, if we actually made it a dollar amount, would total probably more than most of us are making outside of the home. So I just want you to realize that, because what happens is that when women and men, when husband and wife are looking at protection for the family, such as in life insurance, often what you hear is the husband has life insurance, but I stay home, I don't need it. And yes, you do, because if anything happens to you and you are critically, chronically, or terminally ill, somebody's going to have to take care of all those other things you do. And if your husband has to continue working, you're going to have to hire somebody, and that costs a lot of money. So let's, again, become very, very proud of what we do and continue to educate and empower each other. Speaking of empowering each other and educating each other, here's Angelina Jolie. You may or may not like her. She's very famous. We know that. And she's a very strong-willed woman, which is what I respect her for. And she says something very simple, which is very true. There is no greater pillar of stability than a strong, free, and educated woman. So I will say that my mission right now, as I mentioned earlier, is to empower women, as many women as I can, through financial education. Why? Because I believe that when a woman has power in the house, the home is a place of peace and love. I have met way too many. I've lived in the US since 1993. I moved here from Spain. I started as a teacher in 96. That's a long time from now. I have worked with so many children and so many families where the women were not empowered. They didn't have the financial means to leave bad situations, and they didn't have the financial means to say, you know what, respect me right now. This is as far as I will take your yelling, your whatever it is, right? And so I believe that it's the more women that we empower, the more women that we give the possibility of making decisions on their own, the better the world will be. We'll be able to protect more children. So that, again, is why I wanted to stop here, because it's very important that we consider that. I'm going to share with you a little bit about the company that I work with. I'm an agent. We have, thousands and thousands of agents in this firm. But I work for a company called World Financial Group. And World Financial Group is actually, it comes with a very interesting history, a very cool history, I think. About 20 years ago, a company out of the Netherlands in Europe called Aegon, you'll see here on the top left, that had already been doing financial services in Europe for about 100 years, decided that they wanted to start offering financial services in the US. They are one of those companies that are too big to fail, have billions and billions of dollars in assets. And so they went ahead and were very strategic, and they purchased two different companies. The first one is Transamerica. Transamerica is a financial services firm that also has a history of about 100 years in the US. And they purchased a second company called World Financial Group. World Financial Group is a distributing company. So we always say, as kind of an inside joke, that it's like the Amazon of financial services, because WFG does not have its own product. It is simply a platform that does all the operations and administrations for the agents and allows us to contract with a number of different companies in the US so we can provide the best services to families. We have Pinnacle Agency on the bottom right. Pinnacle Agency is an office here in San Jose out of WFG. Since it's so big, we're in all 50 states, Puerto Rico, and Canada. There are offices in different parts of the country, obviously, and I happen to belong to Pinnacle Agency. That's where I met Carolina, and that's where my training took place until COVID, and then everything was done on Zoom. Let me share with you a little bit about the choices that we provide and the reasons why I think, our job is so unique, and the reason why I love what I do so much. We represent the client, and we offer lots of choice. These are some of the most popular services that we can bring forward. So we do a lot of 401k and IRA rollovers for people who have noticed that their 401k has been losing money in the market. We can protect that money. We also provide education and guidance around life insurance. We have so many different types of life insurance now that it's important to have somebody who can help you navigate that system. We also provide long-term care and college plans for kids, index universal life and fixed indexed annuities, executive bonus plans and legacy planning, wills, and living trusts. So it'd be great for you to write down what you already have and what you would like to learn more about. So even if you have life insurance, a lot of the time I get people who say, I already have life insurance through work. My question is, do you understand how it works? Do you know whether it covers you every day of the week, every week of the year? Does it cover you on vacation? How much are you paying? Are you sure that you're not paying too much for too little? So we go further. I sit down with clients and we do a 3-way call. And we call the company so that I can make sure that the clients understand what they have. And then we do some comparisons if that's a need. So write down what you do have and what you'd like to learn more about, because that's a great place to start. Another thing I wanted to share with you is that we also have a lot of variety and choice when it comes to the companies that we work with. So as I said, I work for a company that is like a platform. We are brokers, right? It's a broker dealer company. And so I am able to look at plans and offer policies for anywhere between 70 to 100 companies every year. These are just some of the most popular, the ones that most people know because they've seen them on commercials, etc. I'm sure you recognize some of these. They're all rated A and above in order to be in our platform. A little bit of research in terms of family habits. We have family A in America and we have family B. Two very different types of families. 95% of families in the US fall into family A. And these are families that are making $100,000 or less. They have a job. If they have a retirement plan, it's through work, like a 401k. If they have life insurance, they usually have it through work, which is temporary and it will expire. They tend to rent a home. They put money in the bank for savings. They do have credit card debt at some point in their life. They are not able to take advantage of the tax systems because they don't have an advisor or a plan. They don't know how it works. So, they're doing the right things, but they don't have a lot of information. Then we have family Bs. Family Bs are 5% of the population. And these are families that are making more money, obviously, but they're also business owners. They no longer want retirement plans like a 401k. They want an indexed account for the future. They don't want temporary life insurance. They don't want to rent life insurance. They want to own life insurance. So they have a life insurance that will leave a legacy behind. So one of the things that I learned right away is that the wealthy have life insurance plans, permanent life insurance plans for everyone in their family. And that way, the next generation will get a wealth coming down to them through life insurance. Life insurance is the best way to leave a legacy. They're also homeowners. They diversify their portfolio. They don't have debt, so they're debt-free. They maximize tax advantages, and they do have a financial professional. So again, it helps to have somebody who can guide you through all of the different systems. We also know that most people don't fail to plan. They just simply, let me pull this up. I don't want to say it the wrong way. I have something in the way, but most people don't plan to fail. They just fail to plan. I knew I was going to say it right, but I just wanted to double check. It's true, right? No one wants to fail, but we just don't plan enough. We need to plan, and we need to plan with someone who knows this field well. Let's talk about the 3 rules of money. The first one is the rule of 72. And the rule of 72 describes compound interest. We're going to take an individual who's 29 years old and has $10,000, and we're going to put those $10,000 into 4 different accounts. The accounts are going to give a different percentage of interest, right? And we're going to use the rule of 72 because number 72 is the magical number. This is actually something that was discovered by Albert Einstein. If we take the number 72 and we divide it by the percentage of interest that we receive in an account, it tells us how many years it will take for that money to double. So if we take $10,000 at the age of 29 in an account that gives us 1%, 72 divided by 1 is 72. 72 years after that, I would be 101 and I would have $20,000. If we find an account that gives us 4%, 72 divided by 4 is 18. Every 18 years, the money will double. It's a lot better. If we find an account that gives us 6% interest, compound interest, 72 divided by 6 is 12. Every 12 years, the money will double. And if we find an account that gives us 12% of compound interest, 72 divided by 12 is 6. Every 6 years, the money will double. Let me show you a couple of interesting things. You'll see here, for example, at 65, we would have $40,000. And here at 65, we would have $80,000. The money has doubled, but the interest has not doubled. That's because compound interest is like a snowball that goes downhill and gets big very fast. It catches momentum. If we have an account that gives us 12%, here we did double, right? From 6 to 12, it is a double. But if you look at what happens at the age of 65, for example, we're looking at a lot more than doubling the money. And that again is because of compound interest. So you can ask, if you have children, you can ask your child, which account would you like? And they would say the green one, the big number. Of course we know that. But what most people don't realize it's that it's not enough to look at an account that gives you a high interest. You also want it to be compound. You want to be growing interest on the money that you put in and on the interest that you earn, so that money can grow faster. Let me also flip around compound interest. Let's talk about when compound interest is dangerous for us. Compound interest is used in every agency for every type of plan that loans money to us. So whenever we borrow money from a credit card, for student loans, a car loan, a home loan, anytime we borrow money, they are using compound interest against us. So you can take a look at the interest of the money that you owe, and you can do the same math. 72 divided by 3.5 interest, 72 divided by 19. That will give you how many years it'll take for your debt to double. You're going to owe double what you owe today if you do not pay it off very quickly, essentially. Second rule of money is how money grows. And we have three different types of interest, three different types of systems. So we have the fixed interest, like what we have in a bank. So when you put your money in a bank, they tell you you're going to make 0.5% interest, and that's the amount of interest you will make during the whole life of the account. Then we have a variable account. A variable account is an account that is invested in the market. So what does that mean? That means that your money will grow and will lose, and will make money and lose money, make money, lose money, based on the performance of the stock market, right? Based on the market value. The third type of account is an indexed account, and this is a hybrid of the two. It's one of the best kept secrets. The wealthy know about these accounts, and that's why they use them. And they're available to us, but you have to be sitting with somebody who's licensed who can offer these plans to you. But this is how it works. These plans will mirror what is happening in the market only in terms of growth. So if the market is doing well and there's growth, the money that you put in will grow interest. But anytime there's a drop in the market, it doesn't matter how big or how small, that money, everything you have in your account, will stop at 0% interest. When the market does well again, you'll grow money again. When the market drops, it stops at 0%. So either grows or stops, but you never lose money. And that's why there's such a beauty behind these accounts, and that's why banks use these accounts and large companies use these accounts, because they know that their money is safe. The last rule of money that I'll share with you today is how money gets taxed. And we have three different tax systems as well, three different ways of saving, of working with your taxes. We have accounts that are considered tax now. These are accounts such as savings accounts, bank CDs, brokerage accounts, and mutual funds. These accounts will take your contribution after you pay taxes on your income. So let's say you make $5,000, but you only take home $3,000. The other $2,000 goes to the IRS. Out of the $3,000, you'll put some money into this account, and this could be any money you choose, right? $100, $1,000, it doesn't matter. However, every year at the end of the year, right before tax season, the bank, for example, will send you a statement that will say, you made $3.15. Please report that to the IRS. You made $100.12. Please report that to the IRS. They only give us a very small percentage, and then they charge us again on money that has already paid taxes. So I want you to be aware of that. That's where most people have their money. Then we have accounts that are considered tax later accounts. These are accounts such as 401ks, 403bs, IRAs, SEP IRAs, annuities, and pension plans. These are plans, retirement plans, that come to us through work. All of these plans have something in common, and that is that you will not pay taxes now, you'll pay taxes later. And that sounds wonderful, but let me share with you a little bit about how these plans work. You will contribute, let's take a 401k because they're very popular. You will put a little bit of money into your 401k, a percentage. Let's say you put 3% of your income into the 401k. Your employer will make a match. They also put in 3%. So you put in 3, they put in 3. That money will stay there and grow until you retire. Once you retire, you have to pay taxes on the money that you put in on your 3%. You pay taxes on their 3%, the employer's 3%, and on all the interest that is received. If you touch that money before the age of 59 and a half, there's an additional 10% penalty. So what happens is that the IRS doesn't want you to touch that money until after 59 and a half. They want that money to grow as much as possible because they want to take a bigger slice in the future. The companies, the employers, this is very important information as well. The employers want you to have a 401k because it is a tax write-off for them. And it is also an asset. So if a company, and we saw this in 2008, if a company goes under and they have financial trouble, they can pull money from the 401k plans to stay afloat. And whatever money is lost, they are not responsible for paying back. So this is very important information because we also know that a lot of people in 2008 lost about 40% of their 401ks and they could not retire. So be aware of where your money is and how the rules are for the plans that you have. The third type of tax system is called tax advantaged. And we have these different types of plans that fall into this category. Municipal bonds, Roth IRAs, executive bonus plans, and cash accumulation in an insurance policy, also known as life insurance retirement plan. These plans are a little bit different. They're very cool because the way that they work is that it's similar to a savings account or a bank CD. You will contribute money that has already paid taxes, post-tax dollars. So if you made $5,000 and you only took $3,000 home, out of the $3,000, you would put $100, $1,000, whatever you want into this money, into these accounts. And the difference is that a bank account, you'll have to pay taxes on the growth every year. These accounts will let you grow your money tax-free. That's why it's called tax advantage. And so we want to make sure that we understand that we have more choices than we know. Most people know their choices at work, and then they understand that they have banks as well. But they don't know about this because they've never sat down with a licensed professional. I'm going to ask you a couple of questions. I do like to have, some questions that are real practical, real life situations. But let's say you had the chance to pay taxes on your seeds today or on the harvest in the future. What would you rather do? Pay taxes today or later? You can think about that. You can type it on the chat, whatever you would like. But let me ask you the second question. Do you think income taxes will be higher or lower in the future? A lot of people are thinking, maybe I'll pay taxes later because I'll have more, I'll be wealthier. Right now, paying taxes is so hard because I don't make a lot of money. And they're thinking that taxes are always going to be the same, but that is not always the case. Let me show you something that you can research yourself online. Top marginal federal individual income tax rates, right? So income tax rates have only been around in the US since 1913. That is the first year that the US had income taxes. It was a kind of a social experiment, right? To cover all the social benefits that we know and we live from. And there's nothing wrong with paying taxes. But I do want you to understand how they work. When they first started, they were below 10%. But the following year was 1914, World War I. So that made tax rates go up really high. As they were beginning to come down, we had 1929 with the stock market crash, the Great Depression, and then again, tax rates went up. And they never quite came down because then we had World War II. So it wasn't really until 80s, right, somewhere in the 80s and now that we've had tax rates live where they live. And yes, this is for top marginal income taxes. That's for people who make the most. We probably are not here, but even if we're not here, we know that we are going to be parallel, right? We are also going to move up and down in tax rates according to historical, financial, economical events of the US and the world. So I will leave you with that because I think many of us who are either younger or haven't lived here our whole life, for example, when I moved here in 93, I was still in college. In 96, I started working as a teacher. So everything I've known is this. And I remember when I would get my paycheck as a brand new teacher in 96, and I think I was making like $1,900 a month. And I would get my paycheck and a third of it was gone. And of course I would complain. I would be in the lunch cafeteria, in the lunchroom with the teachers. And I would say, this is crazy. A third is gone. How am I ever going to make it, right? And teachers who were older would kind of laugh at me and say, "Oh my gosh, you have no idea what high taxes are." And that's because they experience this as well. They were close to retirement. They knew that taxes could be higher. So it's important for us to know. Summary of what we covered today with the 3 rules of money. The first is the rule of 72, right? We talked about compound interest, and that describes the accumulation phase. We want our money to be growing and to be growing fast. The second one is how money grows. That's the second rule, that it describes protection phase. Do you want your money to be so protected that it's not growing? Do you want it to be protected and growing? I'm sorry, let me take that back. Do you want it to be so protected that it's not growing? Do you want it not to be protected at all? I got excited here when I was going up, but I'm like, no, it comes back down. No protection. Or do you want it to be protected and growing, which is what happens in an indexed account? It's important for you to write that down as well. The last rule describes how money gets taxed, and that's the distribution phase. It's not enough to have a lot of money in an account if it's not all yours. So depending on when you pay taxes, you'll either pay taxes every time you put money in, and every year you'll pay it later at a very high rate, or you can pay it once and be done. So it's really important to think about when you're paying taxes. This quote is an important one, and it's one by Warren Buffett. Obviously, he's a billionaire. We've seen the name before. We know who this is. But he says something that's really smart, and I always share it on Facebook, and I remind myself. He says, do not save what is left after spending, but spend what is left after saving. How many of us, pay our bills and our mortgage or our rent, everything we have to do, then we go out and we have fun with our money, and at the end of the month, if we have money left, we put some money away for savings. That's what I used to do. But it's important to understand that if we do that, we most likely won't be putting money away, because there's always something fun to do with our money. But if we spend what is left after saving, if we pay ourselves first and save first, and then budget the rest, we're more likely to save. Great. So here are the 6 services that I encourage you to think through. We offer financial information and guidance, obviously, and we help in 6 different areas. The first is helping families who want to increase their cash flow. The second is college planning. If you have children and you're interested in seeing about, saving for their future, we should definitely talk. Emergency fund. How do you save for 3 to 6 months of income in case of an emergency? Number 4 would be to sit down to look at proper protection. Is your family properly protected, right? So that's against loss of income. Obviously, if something happens to your life, we want to protect our family as well and protect our assets. Number 5 would be to help you build family wealth, right? We want to make sure that your money is being managed correctly and that you are not falling behind with inflation. Right now, I actually shared something about this in the last few days, but inflation is 8% or above at this point with everything happening in the Ukraine. And what that means is that if you're not making at least 8% on your money, or your raise at work is not at least 8%, we're falling behind. So it's really important to build wealth. And the last service, number 6, would be to help you preserve that wealth. So if you do have assets, if you do have money, we want to protect that, and we want to do it through a will and a living trust, so that you can pass all of that down to your beneficiaries, tax-free, right? And we don't have any money that is gone and taken by the government. So I will ask you, which of these 6 services, if not all 6, is most important to you now? You can write that down for yourself as well. Great. I'm going to actually go over 5 minutes really quickly for any of you who are interested in learning about what it means to be a financial agent working from home and having your own business. So if you would like to stay for this, I invite you to do so, because you'll learn a little bit about how we get paid and what the work entails. It'll be 5 minutes, so I'll go through it very quickly, but it is important for me. I do feel like we need to know about other possibilities. We don't have to have a traditional job to be able to make a decent living and actually make good money, and it can give you more quality of life, which is what it's done for me, because I now work from home. I get to create my schedule. I work when I want, where I want. So let me tell you a little bit about our company. We get paid in 5 different ways as financial agents. The first way we get paid is personal income. So of course, clients that I have, once they decide on which company they would like to apply for and which type of plan. Once they get approved, I receive a commission, right? So it is commission based, and that's my personal income. But I also receive agency income. I have agents that I'm training, and as I train them, the companies give me a commission. And as they become independent and have their own clients, the companies also give me a commission based on those clients that they have. So as you can imagine, it grows, right? It's almost like compound income. We also receive expansion income because we can now work in all the US, in Puerto Rico and Canada. So I'm licensed in different states. I'm not just licensed in California, but I have licenses in different states, and I continue to have more licenses depending on where my clients and my agents live. We also receive bonus income and recurring income. So you can take a look at those if you're curious. Our average, per month and per year income is here. And we have different levels. We start as associates, right? So we're brand new to the company. We're being trained. That's different to somebody who has more experience and now has a lot of agents who are independent. But you can see that our income is very attractive. So we go from anywhere from $4,000 for one client if they're saving, about $1,000, or if clients who are saving a little less, the average is for every $1,000 that is saved, we make about $4,000 in commission. So you can imagine that is a very, very attractive income to have. And for the same amount of work, depending on where you are, if you're a senior marketing director or if you're a senior marketing director with more people on your team, the salaries monthly are much, much higher. And so you can see that it grows quite a bit. And we have a lot of people who are millionaires in the company already. I'm not there yet, but with enough work and time, I definitely can make it there if I choose to. Let me tell you a little bit about the company at large also, because I think it's important to understand how big of a company this is. It's not a small company. When I chose to work with WFG, I did a lot of research, and I realized very quickly that this company has all of the support of the major financial companies in the country. You're talking about Transamerica, Pacific Life, Nationwide, right? All these companies that stand alone are very strong. When put together to back up our services, it means a lot. So I definitely felt that confidence coming in. WFG at this point has helped closer to 5 million families, where this was 2020, so it's higher than this, but let's just look at 2020 numbers. Since 2001, 4.6 million families had been helped. All our companies, all of the providers have to be rated A and above, and I mentioned that earlier. And then also we'll take a look at how many life license agents we have, me being one of them. We're at around 55,000 at this point. In fact, with COVID, a lot of people said, you know what, I do want a career where I can work at home. And when they learned about the opportunity, they took on the challenge. In terms of how much is paid by the company to all the agents, these are the numbers year after, in the 3 key years. So 2011, the WFG had already paid about $300 million for that year in commissions to all the agents. In 2015, that number had more than doubled to $732 million. And in 2020, it was close to $1 billion in commission. The company is growing, like I said, compound interest plus. It's growing very, very fast. These are just the representations of executives in our office here in San Jose, the main office here in San Jose. And you can see that there's such a variety of people, backgrounds, right? Eric Olson and his wife started in about 15 years ago, and they're now making $9 million. They started the office here in San Jose. We have agents and brokers from all over the world. Some of the ones that I'll point out are people that I've actually met and that we hear from a lot. When Eric Olson started the office, he invited his best friends. Juan Jaime was a plumber from Mexico, super charismatic, really fun. He's already a millionaire. He also invited Mario Bayona. Mario Bayona was a busboy. He was the one who was collecting plates at a restaurant, right? He didn't even speak any English, and he's also a millionaire at this point. Paul Hart was a mechanic, same thing. They're making over $1 million. So is Randy Sekairos. He was a soccer player in Europe, playing soccer with a team in Europe and had to come back for a family emergency, and he started the business and he's doing really well as well. And then we have teams from all over the world. So we have teams from Africa. This couple right here, she was a doctor and Daniel was a nurse. They both started about 4 years ago and are already making over $3 million. And that's because they reached out and all they did was help their community. So a lot of the people that you see here, that they are African American, I guess, at this point, but they're actually from Africa. They still have their accents. They're doing extremely well. Dr. Kwende right here was a pacemaker surgeon. So he was already making a lot of money when he came into the business, but he was looking for quality of life. He didn't want to work, be at work so many hours every day, not seeing his kids. And so he decided he wanted to try something different. And thanks to that, he's been able to do really well. Here's Carolina when she had longer hair with her husband Santos. They're both executives as well and doing extremely well. And you can see that we have every color, every shape, every flavor, and every age represented, which is really great to see that, obviously we can all help others. The company likes to recognize in different ways. I love the fact that they have so many trips and that you can take your family along. So if that's something that interests you and you're thinking about, where could I work that I could also do a lot of traveling, this would be a place to do that. And then the last thing I want to leave you with, and we're going to end in 2 minutes, is looking at where you would like to go next. What would you like to do next? The first option is one that we honestly think you should take. It's free, obviously, it's complimentary. And that would be to sit down with the person who invited you today so we can take a look at your financial status right now. What are your goals, right? What are you hoping to improve? And if you're in great shape, how well do you know the products that you have? If you have life insurance, how well do you understand your life insurance? If you have a 401k, how well do you know it, right? Our goal is to always educate first, and then people can make decisions based on their needs. The other two options would be for people who are looking to start a career in finance. And the company allows us to do so as a part-time employee or a part-time agent or a full-time agent. We shouldn't say employee. We're all business owners and independent, but we do offer mentoring. So just like Carolina was my mentor and I'm now mentoring others, right? This could happen to you as well. Both part-time and full-time business owners have to get their license with their state, wherever they live. And that is a super easy process. So if you're interested, obviously, let us know. So with that being said, I'm going to actually stop